Hello, everyone. Welcome to this Q&A and presentation from Fnac Darty. Welcome to all the participants. I see that Stephanie is connected. Welcome, Stephanie, and thank you for joining us.
Hello, everybody. Happy to be there and to share what I can share on Fnac Darty, but happy to be there.
I'm sure it will be fantastic. Guys, can you make sure that your microphones are off while Stephanie does her presentation? So the program for today is to do, I don't know, 45 minutes presentation on the group and maybe Q3 results, and then we'll do a Q&A. So we're on Zoom. I think Zoom is you raise your hand, right? So please raise your hand, and then I'll handle the virtual mic to you when we do the Q&A. But as for now, let's start with Stephanie and the Fnac Darty presentation. Thank you, Stephanie.
Okay. So I will share.
Yes.
I think I cannot share.
You can't?
No, it's written that you. Yeah, I can. Like I send it to you or. Yeah, maybe it's okay now. Yeah, no, okay. I think it's okay.
Okay, great.
Just tell me if it's okay, if everybody can see.
It's coming. Yes, it's perfect.
Put it on full screen. Is it okay for everybody? Yes.
It's perfect. Yeah.
Okay. So I will give you, so hello everybody, I will give you some information regarding the Fnac Darty group, and I will be happy then to answer all your questions. So first of all, so I'm Stephanie Laval, I'm the head of investor relations at Fnac Darty. It's been 2 years now, so a lot of changes regarding the Fnac Darty group, and I will give you some figures and some strategic trends we've made in order to for you to have more information regarding the Fnac Darty group. So first, if you look at Fnac Darty at a glance, just to give you an overall picture, we are, so Fnac Darty is a European omnichannel, leader with a revenue of around 8 billion euros and with a total employees of more than 25,000 employees based, of course, mainly in Europe and especially in France. So as I just mentioned, Fnac Darty is one of the top European, omni-channel retailer. Roughly 1/4 of its total sales, are made online. So the people, they order products online on our Fnac.com or Darty.com websites. And what is important is that 1 online sales out of 2, is omni-channel, meaning like we call click and collect, meaning that you order products online, but you pick up, the products within our stores. So this is important for us, and this is a key asset for us to have roughly 1,000, stores, mainly based, in France. But this is important for us to have that kind of, network in order to get this 50% of omni-channel, sales. So we are based in 12 countries. If you look at the chart at the right side, we have even if we are, present in 12 countries, we are of course the vast majority of our activities made, in France. If you look at the right side, France and Switzerland, they represent more than 80% of our total revenues. And of course, France, a vast majority of that kind of 83%. We are also present, in the Iberian Peninsula, so in Spain and in Portugal, which roughly represent 9% of the total revenue. And also in Belgium, in Luxembourg, which represent 8% of the total sales. And the other countries are through franchises, like in Tunisia, in Qatar, etc. So those are the other countries where we are present, but it's also through franchises. what is important is that within, you know, our network, our store network, we have more than 40% that are stores made through the franchise contract. So the other 60% remaining are through integrated stores. So this is a different way of doing business, and I can enter into detail if you have additional question on that. And what I just mentioned before, what is important is regarding, you know, the click and collect, so the omni-channel, meaning that you order online and you pick up in the store the product, is that we have in France roughly 90% of our customers that are that have a store, so a Fnac or Darty stores, less than 15 minutes from home. Another key topic for us is we are #1 of after-sales service in France. It's mainly through our Darty brand because it's a large part of our business now regarding, you know, repairing products. So not only, you know, selling, you know, new products, but we also repair products, because we do consider that, you know, sometimes the products can be repaired, and it's let's say something that is increasing in our business model. So to give you an idea, we have repaired more than 2 million, you know, products last year, and we have roughly 3,000 people dedicated to this activity. On that slide, just to give you an idea of our positioning regarding the main markets we are, you know, doing business. If you look at the figures, even if they are from 2019, those are quite the same today, meaning that for each main categories of the products we sell, so the first one is like laptops, or what we call technical products, which represent roughly 50% of our sales. What is important is that we are in that kind of categories, you know, we are more selling, you know, what we call top range products, so with higher quality, and it's representing on the slide you have at the screen, meaning that we are over, you know, represented on the market share from top range, you know, high range products than low range or entry range products. So it means that we have the capacity to have that kind of positioning on high-end products. It's the case for laptops, it's the case for TVs, it's the case for what we call appliances, large and small domestic appliances. So in those categories, we have a better market share compared to the market on those kind of high-end categories, which could explain the fact that if you compare Fnac Darty to other competitors, we have a good positioning, especially for the time being, you know, with the inflation rate that is quite high. If you look now at our current shareholder structure, we have three main shareholders, which you can see on the right side of the slideshow. Seconomy, which holds 24%. It has been, you know, a share, let's say, an historical shareholder since 2018, and roughly its position is quite stable since 2018. Seconomy, you know, is another retailer, which, you know, its activity is made more on Germany or other European countries than our countries. The second shareholder is Vesa Equity, which is quite a new one because it just entered the shareholder structure. You know, it's been now approximately 1 year. It holds now 20% of the company, and is really supportive with the strategy, the company strategy. And the third one is Indexia, which name was SFAM, sorry, which now hold 11%, and it's quite stable since it just entered the group. It was in 2018. So those are the three main ones. And what we say, the public, you know, structure is made of a little bit more than 40%. If we now look at the strategic achievements we've made, so on that slide you have an overview of what has been made for the group. So just have in mind that Fnac and Darty, they have merged, you know, at the end of 2016. And then between the 2016 to 2018, the group has to, you know, to integrate those two brands within one single group to make some synergies, and synergies were made at a level of 130 million euros. So it was a good thing for the group. And since 2018, the group has launched two strategic plans. The first one was Confiance Plus, between 2018 and 2020, so just before, you know, the COVID crisis. And the aim was to develop, you know, this new group to expand the franchise model with the stores, to expand the online sales. Those were the two main, let's say, directions that were made, you know, within the Confiance Plus, let's say, strategic plan, which has been a success. And we've launched now a new strategic plan since the beginning of 2021 called Everyday. And I will give you some details on this new strategic plan. So new direction for the group after, you know, let's say, the COVID crisis, even if we are still in another, let's say, crisis, but it was a new directions given to the group. What we are convinced, and that was, you know, the main direction the group took, you know, to put in place, you know, its new strategic plan, is that we do believe that omnichannel is the winning model of retail. Meaning omnichannel, meaning that you can have both, you know, stores, so physical stores, and online, and you can make complementary, you know, synergies, etc., between this kind of retail model. So we do think that only a pure player models, or only a physical or a store model, you know, is not the winning model. We do think that omnichannel is the winning one. The second conviction we have is that advice and services, you know, are necessary to the purchasing act. So advice is because you have some sales people and sales vendor, and they know, you know, how to advise you when you get in the stores, and this is something plus we have compared to just online retailers, for instance. And services is also key, and it will be part of one of our main pillar, you know, that we've developed in our main strategic plan, because, you know, when you buy a product, even if it's an appliances or a TV, and if you buy, you know, high-end, you know, entry product, product, you know, you would like to have advice, to have service, because if it's broken, you need to phone somebody to get repaired, and it has to be easy. And this is something that we take very important, that kind of thing, and that's one of the main pillars we have developed in our strategic plan. And the third conviction we have is that consumer behaviors are more and more, you know, driven by environmental concern, and it's of course key. So that's the reason why we have developed, you know, that kind of repairing services, and I will develop other things I will explain just in our strategic plan. But those are the three convictions that, you know, that have fueled, you know, our new strategic plan, and that have been adopted in our raison d'être. What we have is that commit to an educated choice and a sustainable consumption. So this, we think that it is our main and our key role. Moving to the strategic plan we've presented to the market, you know, beginning of 2021. It relies on three main ambitions. The first one is to build a digitalized, you know, omnichannel retail. So we will see that we have accelerated in the online part of our business in order to address all of the product consumer expectations. The second pillar is, of course, to lead durable behaviors. And the third one is regarding more regarding, you know, services, because we do think that we have something to play on that field, and we have launched, you know, a new subscription-based service called Darty Max, and I will give you some some details on that service. Looking at, so the first pillar, which is build a digital omnichannel retail. So in that pillar, what we have observed is that we have increased a lot of our online, sales during the COVID crisis. And we still have, large part of our sales that are made online, even if they only represent, 1/4 of our total sales, so roughly 25%. But we do think that we have customers that prefer, ordering online, but also they would like to have some key experience, some experience with advice. Like that's the reason why we have put in place, the possibility for a customer that is online to get a chat, a video chat, we as salespeople that are located within our stores, and they can advise the customers on some products. They can make a demonstration. They can, they can have the same quite advice that they can have in the stores. So that's important for us, so that even the online customers have the same service that within the stores. We also have put in place some live stream sessions. So it's sessions where customers are online and they can have a full demonstration and full advice on a specific product during, 30 minutes, for instance. And so they can order it after because they have all the elements, to get the purchase. So this is something new, that is something that is working quite well. That's the reason why we do consider that online business and in-store business, they can be complementary. And regarding online, we also have implemented a new partnership with Google. So it was quite recent, it was at the beginning of middle of this year, in order to improve our research tool, our search engine, so that we can, answer as quick as possible to the precise, customers' expectations. And we have a target that we've given to the market to reach 30% of online sales by 2025, and we are well on track to reach that target. When I say retail, when I say omnichannel, business model, I mean also stores, because we do consider that stores are a key asset, and that's the reason why every year we just have around 40 new stores openings, mainly through the franchise model, in order to cover, all the areas we are present in. And this is part of our business model and the success of our business model, thanks to, the click and collect rate, which is quite important for us. And we would like, to maintain this click and collect rate of around 50% of the online sales. Regarding the stores, we pay very much attention to the fact that having a large and a wide store network is good, but we would like to have it 100%, of integrated stores that are profitable, of course. To give you an idea, we had 95% of integrated stores that were already profitable at the end of 2019. So meaning that we have several action plans for the let's say the 5% remaining stores that were not profitable, and like, for example, reducing some square meters, transferring some stores from the city centers to what we call the retail parks. We have several action plans, and they will all deliver the result to get 100% of our store networks that will be profitable by 2025. If we now move to the second pillar, we could have two actions on that kind of pillar. The first one is to give to the customers more information on product sustainability. We publish every year what we call a barometer on the sustainable choice. It's a rank. It's a study where we rank, all the main brands and the main product we sell by category and on sustainable, let's say, criteria. Meaning, first, if they broke, how often do they broke, and the second thing is how long are the spare parts available, because of course if you have spare parts available for, I don't know, 5 years or 20 years, this is not the same, you know, sustainability, you know, criteria that you can take into account. So this is important for us to give the customers all that kind of information when you get the purchase, when you purchase, you know, the product. And of course, it has a benefit for the brands, because they prefer, you know, to get, you know, well ranked within this kind of documents, so that they work on having longer spare parts, for example, that are available. So this is the first one, the first part. And the second part is that, as I just mentioned beginning of the presentation, you know, we accelerate on the products, you know, repairs. So we have we repair more than 2 million products, you know, last year. And we aim at having, you know, more than 2.5 million products repaired by 2025. We are accelerating on that, thanks to a partnership we've put in place, who is just signed with Apple. It's just an example, so that now you can have all your Apple phones, you know, repaired within the WeFix, you know, which is a subsidiary we have especially dedicated to repair. So you can have all your Apple phone repaired with, you know, some Apple spare parts now. So we are, you know, we are authorized to do that. So it will increase, of course, the number of products we will repair. And of course, we are acting on the reduction of emissions, of CO2 emissions. We have a target of reducing those CO2 emissions, you know, by 50% by 2030, if we compare to 2019. We have those two main actions on the reducing the transport, the emissions linked to the transport of the products, and the energy emissions, of course, in the stores, for instance, so all the electricity and heating energy. So yeah, those are the two pillars where we can have some action plans in order to reduce those CO2 emissions, because those are scope 1 and scope 2 emissions. I don't know if you're familiar with that, but we can come back on that, of course. Moving to the third pillar, which is called Darty Max. Darty Max is a subscription-based service we've launched at the end of 2019. So for 10 euros, starting from 10 euros per month, you can have all your large domestic appliances, so washing machine, oven, refrigerator, for instance, get repaired for free for no additional cost. So you don't pay no cost for the spare parts or no cost for the technician coming to your home. So it's 10 euros per month. For 15 euros per month, you have all your appliances plus your computer that can be, you know, fixed. And then for 20 euros per month, you have also TV that you can get fixed, you know, thanks to Darty Max. We get roughly 500,000 subscribers at the end of 2021, so just 2 years after the service was launched, and we aim at having 2 million Darty Max subscribers by 2025. It's quite, you know, it's a really important ambition for us, because you get all the customers, you know, they get loyal to the Darty brand, because as soon as you just subscribe to Darty Max, you know, service, you are more keen on purchasing, you know, some new products to Darty brand, because, you know, they will automatically be integrated into your Darty Max, you know, service. So that's good for the customers, and for us, for Fnac and Darty. What we have observed is that one subscriber to Darty Max, you know, has a higher purchase frequency than the standard Darty customers, and they bought roughly 25% of average basket higher than, you know, a standard Darty customers. So meaning that it's a good things for the group, and so that's the reason why we have that kind of ambitious on that kind of pillar. So those drivers, all those three pillars, they have one big target, is to increase, the free cash flow for the group of Fnac and Darty Group. That's the reason why we have, given to the market those objectives regarding free cash flow. So we aim at having a cumulative free cash flow of around 500 million euros for the cumulative year 2021 to 2023, and to have a run rate free cash flow of above 240 million euros by 2025. What we will do with that kind of a free cash flow, what is interesting for the returns to shareholder, we of course would like to do two things. The first one is to make some tactical bolt-on M&A. So we do have some ambition on that field. We're looking at some of course some M&A, some possible M&A, but we are, of course, we would like to have more M&A that is accretive for the margins. So we'll see, but we have enough room and enough financial means, to do some M&A. And the other things is, of course, to have a shareholder return policy. We have paid our first dividend in 2021, so it was €1 per share. It was the first time we paid a dividend. We have doubled it, this year, so in 2022, and paid €2 per share, and have a target of a payout ratio of above 30%. So it was 37%, in last year, so in 2022, but we remain at having, this objective of a payout ratio above 30%. And if there is additional cash because we do not find any M&A, or I don't know, we could have opportunity-driven decision regarding, incremental shareholder return through share buyback, for instance, or a special dividend. We'll see. If I just give you some key figures, looking at the 2 years we've been through the COVID crisis, so we just demonstrated that we had a good, a good challenge with the 2-year crisis. It was a good challenge for us, but we just succeeded because we have a good adaptation plan of all the stores, all the products, and all the online, the sales, were shifted to online sales, and we have all the capacities to shift all the sales through the online model. So it was a good sign for us. We also have, as we benefit from long-term, relationship with all our suppliers, we could have, this high-end positioning that was quite benefiting for us, even during the crisis and even now. So that's something that is key, and we still, rely on that kind of good thing for us. Another thing was we have a delivery capacities that was really under pressures during, the COVID crisis, but we just succeeded thanks to the partnership ecosystem we have, and through the click and collect availability, because it was one of the good things during the COVID crisis. We not only depend on our just online or just, offline, we have both. So as soon as the store reopened, people came back in the stores, and when the stores were closed during the lockdowns, we have these online capacities. So it was a good thing to have both online and offline activities. During the crisis, we have a revenue that was growing a lot. You can see it on the chart on the left side. We made a +7% on our group like-for-like revenue growth. So we clearly benefited from the COVID crisis, because people, they had a lot of savings, and they would like to re-equip or equip themselves. Just to give you an example, we've just seen that before the COVID crisis, you get approximately, one or two laptop within a family. But now with all the courses and the classes, the children have to just follow through online courses. They need a laptop. So for instance, a family has to equip all the children with laptops. So this is one example among others, so that we have benefited from that kind of re-equipment or new equipment during the COVID crisis. We get a current operating income that was quite stable compared to the 2019 pro forma, basis, because excluding ticketing, because we have a ticketing activity. But of course, during the COVID crisis, with all the sanitary restrictions, all the concert halls and theaters, were closed. So of course, with this activity has not, of course, been very successful during the COVID crisis. Now it has been reopened, so it's another story. But otherwise, we maintain our current operating income level, which was a good news even during the COVID crisis. And we get an operating free cash flow of 170 million euros. That was quite good also, even during this crisis. I just mentioned on this chart, the evolution of the main markets. Fnac and Darty, is evolving. If you look at the big trends of the main markets we are, so if you look at the domestic appliances, as I just mentioned, you see that since 2020, we have a rise on domestic appliances, because people, they would like to change their old equipments or to renew them. So you can see the rise starting from beginning of the COVID. It was the same for consumer electronics, so laptops, TVs, and telephones and phones. And regarding editorial products, what is good news for us too, it's that, since 2020, it's on a positive trend. We see people buying books, not only ebooks, but books. It has also been helped by the Pass Culture, which has been put in place, in France by the government, helping students to have some euros to buy books. For instance, people age 18 in France, they get 300 euros. They can spend, only in stores and only on editorial products, so mainly in books. It could be on ticketing too, but this is good news for us, and it participates to the rise in this kind of categories. Just to give you some figures, I just look at the time. Okay, I have 15 minutes more to give you some figures. So the group revenue is 8 billion euros. As I just mentioned, it has been increasing, plus 7%, last year compared to 2021 compared to 2020. Gross margin, to give you an idea, we are roughly 30% of gross margin, which is, within this gross margin, you have the different categories that are evolving differently. You have the accretive categories that are more editorial products and appliances. So they have a gross margin above the average of 30%. And then the contrary, you have categories like editorial products, so laptops, TV, that have a gross margin that is a little bit under, the 30%. So the gross margin is evolving relatively to the mix of products we have, but roughly it's around 29 to 30% every year, to give you an idea on that. Yeah. Regarding our cost structure, what you have to have in mind is that every year the group has put in place some performance plans in order to compensate all the impact of the inflation. So it was true, let's say, until the exceptional rate of inflation we are facing since the beginning of 2022. But before this year, we used to cover, thanks to our performance plan, all the impact of the inflation. It means that roughly it represents 30 million euros every year of inflation, impact of the inflation. And thanks to the performance plan we've put in place every year, we traditionally used to cover, that kind of inflation. We'll see for 2022 because the inflation, the impact of the inflation is not really the same. But let's say that the group is used to put in place some action plans in every, business unit, in order to cover all the impact of the inflation. And so we had a current operating income of 270 million euros. So an EBIT margin of around 3.4% at the end of last year, which is quite a good level if we compare to our other, competitors. Thanks to mainly to the positioning we have on high-end and high-range products, as I just mentioned at the beginning of the presentation. So if we look at the net income, it was 145 last year, which is quite increasing all over the year. We are working on financial charges to reduce them year after year, and you can see that it's paying, and depending on the non-current operating income and expenses, but those are mainly, related to some exceptional, as I just mentioned, things when you, for example, close a store or something like that, but it's not, that relevant for the group. Looking at also our free cash flow, because we've gave a guidance to the market, so on that KPI, what you can see is that you can have some switch in the change of working capital. We get something that was quite unusual at the end of 2020 because we had a high level, of inventories. At the end of 2020, we have very low level of inventories compared to 2021. So, in our activity is quite seasonal because we made roughly 30% of our business, in November and December. So represent those 2 months is representing, of course, a large part of the revenue and of the EBIT we get through the year. So at the end of the year, depending, so you make some bets, let's say, regarding your level of inventories and the level of sales you are expecting at the end of the year, and depending on how big the sales are at the end of the year. So depending on the level of change in working capital at the end of the year, but you could have roughly some switch between the end of the year and beginning of next year, depending on the level of the total sales you will get at the end of Q4. But meaning that we were happy with the 170 million euros we get on the free cash flow side at the end of 2021. Looking at our liquidity, so if you're looking at our net debt, which is a net cash at the end of the year, if you look at the end of 2020 or 2021, it's just depending on on the seasonality of the business, because as I just mentioned, at the end of the year you have you made a lot of sales because representing a lot of your revenues, and you will pay the suppliers beginning of next year, meaning that you are in a net cash position at the end of the year. But to give you an idea, if you look at our net debt, at the end of June, which represent roughly the average net debt of the group, we have a net debt of roughly minus 500 million euros, which could be the good level, let's say, of net debt and the average level of net debt the group is facing, which is quite stable if you look at the previous years. So we do consider that at the end of June is the real, let's say, level of net debt for the group. We have some cash, as you can see on the chart, and we have gross debt, but let's say that on average we are a net debt of minus 500 million euros. If you look at the financial strategy we've put in place beginning of 2021. So as you see on the chart, we have no major, reimbursement of bond since 2024. And we have a RCF credit line of 500 million euros, meaning that we can cover the bond we have maturing in 2024. So this is not, something we have a solid financing structure and no major, things to come to 2023. So we are quite comfortable with that financial strategy we have and the flexibility we have. So this is not something that is quite a big issue for us, especially in the current time. So that's important to have it in mind compared to other players, let's say. Briefly, to give you the last figures we've published, for the Q3 and the first 9 months. So we had, since the beginning of the year, we have observed some, let's say, slow decrease, in the sales we had compared to last year. But I just remind you that last year was quite an exceptional, let's say, year. But what is important for us, and you see it on the chart on the left side, is that we maintain around plus 8% growth revenue if we compare to the year to the 2019. If we do consider that 2019 is the last normal year, meaning with no impact of the COVID crisis and no impact of this crisis in 2022. So this is a very good metric, and we are very proud of that level. What we see this year in 2022 compared to last year is that, of course, the sales made in stores are, increasing, because I just remind you that last year, in H1 last year, some stores were still closed because of the COVID crisis. So now all the stores are fully reopened. So that's the reason why we have a better performance, in the stores. While the online sales are more normalizing, which is quite normal if you compare to the year before, where some stores were still closed. A good news is that our click and collect rate remains at 50%, so 47%, but it's totally in line with what we expect. So this is a key part of our omni-channel model. And if you look at the margin rate, the gross margin rate, we think that it's still stable, in Q3 compared to last year. So it was a good news for us too. By product category, to give you just an idea, what we observe now is that regarding appliances, after 2 years, of course, of a lot of new equipment, as I just mentioned before, we see some drop in the volumes, but on the other hand, we have an average sale price that still continue to rise, because we have this capacity to pass all the price increase directly to the customers, because we are positioned more on the high-end products, so we have this capacity to pass all the price increase to the customers. So that's a good thing for us. Regarding consumer electronics, so we have several trends within these categories. We have a good performance of the telephony. So we sell a lot of iPhone 14, for instance, this year, and it will of course continue. So this is a category that is not, let's say, facing some crisis. On the contrary, we have observed some declines in the volumes of IT, so computers, printers, etc., and TV. But we do think that TV, it was more because people were waiting for the World Cup to buy a new TV, and we'll see it in Q4. Regarding editorial products, so this category have all the books, and of course, as I just mentioned, it continued to grow because we have a new books that are coming on the market regularly, and also thanks to the Pass Culture as I just mentioned before. And of course, last but not least, the service category, which is of course still growing thanks to the Darty Max service we've launched so 2 years before, and it's still growing, and we get new subscribers month after month. So it's a good thing for us because of course it has a higher level of margin than the other product categories. So we've put in place in a year of crisis, we put in place some actions plans in order to meet, you know, the customer's expectation in a year of crisis and some tension on the purchasing power. So we do think that, and we have also observed that people and customers, some customers, you know, they still want to have innovative offers and high-end products. So this is a large part of our customers, so that's still good news for us. We've seen a lot of iPhone 14, the iPhone 14 sales were up. We put in place new Samsung smartphones, and it meets, you know, some customers' expectations. So we still have that kind of customers. We still have customers, you know, paying more attention to sustainable offers. That's the reason why we are increasing, you know, our second-hand products. You know, it's of course it's starting. It's just starting, so it will be of course increasing month after month. But we do think that we have some appetite for those kind of products. We also put in place more targeted specific sales events. For instance, during the back-to-school period, we have addressing some bundles, some IT bundles, especially dedicated to students or to home workers. And when we put in place that kind of commercial events with some promotions, but targeted promotions, you know, the sales were up so quickly. So this is something we will pay attention this year, especially in a year of purchasing tension on purchasing power. We pay attention to that kind of commercial events. And to conclude the presentation, to give you an overview on the outlook we've given to the market. So what is key for us is that we still, you know, outperform the market we are evolving in. So since the beginning of this year, it's still the case. We do pay attention to the figures published every month by Banque de France, which publish, you know, on for the French market, the evolution on each on the categories, the product categories we are selling. And since the beginning of the year, we are outperforming the market figures. So it's good news, and we still want to continue. We had a good back-to-school period, so meaning the September month. So we are confident so that we can succeed. You know, the last quarter of this year, which I just remind you is the big quarter for us, because you know this year we'll have, of course, the traditional commercial events like the Black Friday and the Christmas sales, but as well as, you know, the Soccer World Cup, which is the first time it takes place, you know, in Q4, which remains, you know, the big quarter for us. We'll still have keep an eye on our product availability, which is key, especially in those years of crisis, you know. So we'll have the good level of availability of the products in every category we have, and we will keep on increasing, you know, and pass the prices, the increase in prices directly to the customers, particularly in the more premium products, which is a good part of our success. And still, you know, focus on the mix of services mainly driven so by the Darty Max subscription service, which is key for us too. And regarding, you know, our operating cost, we still, you know, reinforce our performance plan in order to cover the vast majority of the impact of the inflation. It could be a little bit, you know, more difficult for us to cover 100% this year, given the high level of inflation rate. But we'll do our best to, you know, to cover the impact of inflation as much as possible. And this is what we have we've given this direction to the market. And of course, we have reduced a little bit our operating level capex for this year to 140. Before it was 150. Is just to reallocate a little bit, you know, the way we are investing, but nothing which is quite, you know, in line with the guidance we've given to the market. So this is the last objective and guidance we've given to the market for 2022. I think I've finished my presentation.
Thank you so much. Thank you so much, Stephanie. It was very complete, I think. Yes, I think the students now have a better idea of the everyday plan and the strategy and the current trading. Guys, let's move to Q&A. Can you just raise your hand? It's on the bottom line of I mean, I'm sure you're very familiar with Zoom, but if you're not, it's in called Réaction in French. So I don't know, depending on your language, you have the opportunity to raise your hand. And also just because it makes things a lot nicer if you don't have any technical issues to open your camera when you ask questions and also state your university or school. So anyone for the first question? Oh yeah, sorry, Francesco, you can go ahead.
Yeah, hi, good afternoon. Thank you for your presentation. I have a couple of questions, especially regarding the goals, the short-term goals for 2025, particularly the free cash flows. How do you plan to basically achieve your goal of run rate of 260 million, around 260 millions, and in cost reductions? And you also have the goal on reducing operating costs. So what do you expect of your new level of margins to be in the foreseeable future? Thank you.
Okay, thanks for your questions. So the first one regarding the free cash flow target we've given to the market by 2025. So it's 240 million euros, not 260, but it's okay, 240, which is quite a significant rise compared to the level of free cash flow we just had. So the last one was 170 million euros if you look at the reported figures. We have a big part of this rise will come from definitely from the Darty Max, you know, service we've put in place. Because if you look at the impact, if you make let's say an easy calculation, you know, so I say Darty Max is around between 10 to 20 euro per month per customer. So you have the subscribers, you have all the number of subscribers we'd like to achieve by 2025. So it won't have a big impact on the revenue side, but on the margin side and on the free cash flow side, we'll have let's say a good impact and a very huge impact. Because of course, you know, it's recurrent revenue, recurrent margin, and recurrent, of course, cash for the group. Given even if, you know, the stores need to be, I don't know, there is another lockdown or things, people, they will pay, you know, because it's a subscription model. So it's something new for the group. It's not depending, you know, on the fact that stores are open or not, if the client would like to pay this month or not. You know, you are engaged with this kind of subscription fee. That's the reason why we've put in place this new subscription model. And you know, what we see is that people, when they subscribe to Darty Max, you know, they, for instance, if you have both, you know, I don't know, a washing machine, you will get the Darty Max subscription. When you will have to replace your refrigerator or your oven, you will be, you know, if you would like to have this kind of product, you know, within your Darty Max, you just have to buy it, you know, in Darty. So it's kind of liability, you know, so you will be having that kind of loyalty coming from the customers, because they will be, you know, just inclined to buy, you know, products within Darty. And also what we see is that those clients, those customers, those Darty Max, you know, subscribers, they have an average basket which is higher than, you know, Darty standard, customers, which is 25% more, and it's something that is still, the case today. So it will also participate, to rise, the average basket, and also to rise, your free cash flow. So it's mainly coming from the Darty Max, of course, service. So this is what your first question. The second question regarding operational cost reduction. As I just mentioned, roughly, before, let's say the year 2022, which is quite specific, but before this year, roughly the impact of the inflation is 30 million euros out of, the roughly 2 billion euros of operational costs we have per year. And we have put in place, but it's been several years since we just put in place some performance plans, which is cost reduction plans within all our business units to cover, that level of inflation, so the 30 million. And roughly, if you look at our operating cost on a constant base, meaning that excluding the new openings of stores or things like that, but you will see that our cost structure, is flat all over the year. Now we are entering, into a new era, let's say, with inflation rate that are not, the same between 2%. But now we are entering into a new area, which are more the inflation rate are higher, of course. So we have accelerating our performance plan. We didn't give to the market any guidance on the level of cost of inflation will succeed in covering, but of course we have accelerated a little bit because we know that it won't be the same impact that it used to be, but of course we have accelerated, and the market has just seen that. If you look at H1, which are the figures we've published this year with our cost, we have succeeded in covering all the impact of the inflation, which was rising all over the H1. So we do not give any precise guidance, but we'll do our maximum to cover the maximum of the impact of the inflation. But of course, if you come from an inflation rate of 2% roughly on average, and now if the average will be, I don't know, 6 or 8%, it's not the same story. But we accelerate our cost reduction, but we don't give any precise guidance. But of course, we still confirm the objectives of free cash flow we've given to the market, so meaning that we are working on that, but we do not give any precise guidance.
Thank you for both your question, Francesco, and your answer, Stephanie. Again, guys, if you want to ask a question, please raise your hand, or you can also ask a question on the group chat. I will ask the question if you are a bit shy. EA, you can ask your question.
Hello, thank you very much for your presentation. My question is about, the stock levels, because you're really dependent on your suppliers. And then, as we know, the supplying chain are being a lot interrupted this year. And we know that especially with microprocessors, we have so many companies that have published not so good results. And we know that the stock of electronic goods will be reduced this year. And how do you make sure that you will have enough supply, enough stock to target the demand? Thank you very much.
Thanks for your question. This is something we have we are used to that kind of question, and of course it's a key question for our business. We have several things that are positive if we compare Fnac Darty to other players. The first one is that we have a long-term relationship with suppliers. So in some periods that are quite, let's say, not crisis period, let's say, when you have good relationships and long-term relationship with the suppliers, you have some power to negotiate with them. And if you look at the figures we have published during the COVID crisis was one of the years where the supply chain were very, yeah, you have some troubles, and on those kind of specific, items, we succeed in having, the best, the record level of sales. So meaning that we know how well to manage, in that kind of troubling time, let's say. The second thing is that we are, as I just mentioned, we are well positioned on high-end products. And if you have like one chip you would like to put on products, on, let's say, on 2 washing machines, you would prefer putting the only chip you have on the high-end product, because meaning that it will get you more margin, even for Fnac Darty, but even for the manufacturer, than on low-end or entry range products, because at the end it will be more margin both for the manufacturers and for Fnac Darty. So as we are more positioned, on high-end and high-range products, the suppliers, they prefer, given high-end products and produce high-end products for Fnac Darty than for other competitors that are more, focused on entry range or low range, products. So that's key part of the equation. And if you look just at the figures, they just say, okay, if I only have one product to produce, let's say, I would prefer producing, the high-end product than the low-end product. So that's one of a key advantage compared to competitors, and meaning that we do not face any, big troubles regarding our supply chain. And look at the level of sales we've just published, in 2020, in 2021, and beginning of 2022. We are really, on a good level of products. For example, regarding the iPhone 14, which is kind of a recent example, you have some let's say inventories that are not that big, but as in France we are the first reseller of Apple products. They do consider us as a big a big seller of Apple, so they prefer selling to us than to others. So that's the reason why we have made so good sales regarding the iPhone 14. So that's a good point. So it's clearly a positive and clearly an advantage compared to others, especially in the years where you have some restriction regarding inventories.
Thank you very much.
Ken, if you, Stephanie, you're fine for 1:45?
Yes.
In terms of time? Okay, great. Oh, a lot of questions coming in. Fulvio, go ahead, please.
Stephanie, like regarding the acquisition, like the one made on Nature et Découverte, in order to penetrate the wellness market. Will Fnac through acquisition still be active in the near future, or, and if yes, what do you think are the most attractive markets?
Oh, sorry, the sound is not that good.
Yeah, I know I have so many problems with the connection this morning, so that's why my cam is off. So will Fnac process of the expansion through the acquisition still be active in the future? And if yes, what do you think that what are the most attractive markets now for?
Okay, so if I get correct your question, it was regarding the M&A policy and the acquisition policy we have now. Is that correct?
Yeah, exactly.
Yes.
Exactly.
Okay, I get it. So regarding our M&A policy, of course, we are looking at things in the market. We are active on that, and we are looking. It doesn't mean that we are looking that we are finding, because it depends on of course on the price, etc. We have several, of course, criteria. We have all the cash. We have some cash, so it's not a cash issue, let's say. So that's not the point, but it's more like on the let's say the targets we have. We pay very much attention to of course so many criteria. We don't think for the moment that it could be, you know, opening, like entering a new country, because, you know, when you would like to enter a new country, you need to have several stores in order to be well known, in order that the brand could be well known, etc. So we do not think that we will open a new country starting from scratch. We could make some partnership, as we just recently made with Manor in Switzerland. I don't know if you're familiar with Manor. Manor is like Galeries Lafayette in France, so a big department store, let's say, with very well known in Switzerland. And we have decided, you know, to double the size of Fnac Darty in Switzerland. But we made a partnership so with Manor, with some shop-in-shop Fnac we have opened within the Manor stores, because Manor is a well-known brand, you know, in Switzerland, but they need our know-how in order to sell, you know, technical products, editorial products. So that could be something we are looking at. If we can make some partnership like we did recently with Manor in Switzerland, we could do it in the other countries we are, for instance, in the Iberian Peninsula, where we are implemented only through the Fnac brand, but why not making a partnership to you know, to expand in those kind of countries? So why not? It could be an option. The other option we are looking, you know, at is reinforcing ourselves, you know, in services, because we do think that it's the key part of the strategic plan. So we could we could have other companies, you know, that are made, you know, on services. And why not? We have acquired, you know, Wefix in 2018. Wefix is a company that is, you know, specialized in repairing, especially the phones. And we have acquired it. We have opened more than we have now more than 120, you know, Wefix stores, and those are, you know, stores where you can have your phone repaired in 1 hour. So that's something that could be complementary to the activities we have, and this kind of acquisition we could make. So this is the main area we could expand. As I just mentioned, on bolt-on M&A. Yeah, this is we have all the cash, and we have, yeah.
All right, Sam, do you want to ask your question now?
Yeah, thank you. Yeah, so my question is, I think you said 30% of online sales will be, sales will be online. And my question was, is there a strategy behind increasing this online presence? And if so, are there any obstacles you predict, or essentially how are you planning to get to 30%?
Thanks for your question. To give you some color, before the COVID crisis, we get at 1 point additional of online sales, meaning that at the end of 2019, we were at 19% of our total sales that were made online, and it was plus 1 point every year, you know, before 2019. With the COVID crisis, of course, we had accelerated because 2 things. Some acceleration is coming from the fact, of course, that the stores were closed, so people, you know, they were buying, you know, online. And the other thing is that what we have observed is that after, you know, the COVID crisis, so 2022, let's say, part of the customers that were used to buy online, you know, they still, you know, they still prefer buying online. But what we observe is that we had a mix, meaning that we have a lot of customers that buy some products, you know, online, but some products, you know, offline, meaning in the stores. So this kind of mix, you know, behavior could be explained by the fact that sometimes you need some advice and you need to have a salesperson, a sales vendor, you know, within, you know, a stores, and you would like to go to the stores. For example, when you buy a TV, well, that's quite expensive. I mean, big expensive TV, you know, you prefer having, you know, see the products and have some advice, etc. When you only would like to buy I don't know, a printer, sometimes you prefer going just online and don't go to the, you know, to the stores. So you have something that after the COVID crisis, of course, you still have that new behavior to take into account, meaning that more customers are buying online. So that's the point. And in order to increase that rate, we have put in place some actions like I just mentioned at the beginning of the presentation. For instance, you could have a video chat with a salesperson, you know, within the stores, meaning that you are online, but you can benefit from all, let's say, the ecosystem and the plus you have offline, you're within the stores. And so that people, you know, they are well advised also online, and so they say, okay, I will keep buying, you know, online because I can have that kind of service and that kind of advice. You cannot touch the product, you cannot, you know, use it, but you have some advice. That is something that is, let's say, something a plus compared to the fact that you only buy online without any other advice. So this is something new, and this is something that is, of course, increasing the online part of the business.
Cool, thank you.
And the other thing is that we have signed a partnership with Google. It was just made before the summer, and it will also participate to increase the online sale, because, you know, you have a lot of people, you know, surfing on your website, but they will have few time and they would like to find, you know, the right product, you know, in few minutes. So you have to have a search engine that is very, you know, performant. And it's a key, of course, asset when you would like to increase your online sales. So that's the reason why we have made a partnership with Google in order to increase the performance of the search engine, and to be sure that when a customer, when a client, you know, is surfing on your website, you won't lose him, you know, until he has just bought the product, and you have some improvement you can make on your website. And this is something also key in order to increase your online sales.
Thank you.
Thank you. Guillaume, do you want to ask your question?
Yes, thank you. Good afternoon. We have a question regarding your debt and the covenant on it. We checked the last 5 years annual report, and we could not find any details on your debt covenant. Can you please give us some clue?
Regarding the debt covenants, we just meet all the debt covenants at every issue we have. So we just publish that. The covenants, the only let's say the covenants we have, we just pay very much attention to is that at the end of June we have a leverage max that we don't want to overpass in the way we see our free cash flow generation and our shareholder return. It's a maximum of 2 times, because I just mentioned that the covenants and let's say that the average net debt of the group has not to be looked at at the end of the year, because it's so easy for us, let's say, because we are net cash at the end of the year, given the seasonality of the activity. You need to see it at the end of June, and we publish our net debt at the end of June, and we just give to the market the max leverage we want, the max leverage, which is 2 times EBITDA. We would like to not be above that kind of leverage in order to be sure that we can have the good level of EBITDA and net debt and shareholder return we could give to the market. And that's let's say the leverage that is really important for us and that we communicate to the market.
Okay, thanks. So that's the only criteria, and if you don't succeed, what happens?
In this leverage? Oh, for the moment, we just have enough room to succeed. We are quite confident in succeeding this kind of leverage. If we don't have this kind of, if we don't meet this leverage, that could have some consequence on the return we could do to the shareholders, to the shareholders. We have other, but be sure that we are confident on the fact that we won't overpass that kind of max leverage. At the end of, to give you an idea, at the end of June, in June 2020, we're at 1.1, and last year, so at June 2022, we were at 1.6. And we have given a dividend, as you've just seen on the slideshow, to the shareholders. So we are quite confident to give both to give dividend, to generate free cash flow, to give dividend to our shareholders, but not to to get additional debt just to pay dividends. It's not the way we see it. So we're quite confident on that. That's the reason why we've given to the market that max leverage, not paying dividend by getting additional debt. It's not the way we see it.
Okay, thanks a lot.
Thank you, Guillaume. Do we have time for a last one?
Yes.
Yes. Okay. Thank you, Stephanie. So I'll ask Tizio's question because he cannot ask it himself. What do you consider when opening new stores, especially in terms of location, city center, suburb, countryside, and what are the main advantages and disadvantages of franchise stores?
Okay. So yes, we do consider that stores and having a wide store network is a key for us, is a key asset for us, provided the fact that it is of course profitable and provided the fact that we maintain our click and collect and level at 50%, because of course it participates to the fact that our online part of the business, being profitable if you compare to other pure players. So that's the reason why we pay very much attention to the fact that click and collect is key. So to have that kind of level of click and collect, of course, you need to have a dense store network so that people can pick, their product. And if it takes, more than 1 hour, you won't have people coming to your store. So that's the reason why in France we have a Darty or Fnac stores that's close to let's say French people, maximum of 15 minutes, which is key in our network. So when we decide to open stores, we decide to open the new stores are with square meters that are not that big. It's more small stores. The location are more, in small areas, because of course with 1,000 stores, you can imagine that we cover all the big cities, all the big retail parks. So it's just to complete, some coverage in specific regions or in specific areas. So it's more, targeted openings. It's not wide openings. We prefer, the franchise model now, because when you are in small areas, you do not have the new, owner to support the big cost structure we have as a big group. So that's the reason why franchise is better. And the other thing is that when you open through franchise, most of the time, those are franchises that coming to Fnac Darty and they would like to say, okay, I would like to open a new store through your brand because you're very well known. And the franchisee, he knows very well the area, because most of the time, is always already a franchisee, but for another brand, and he would like just to shift, its stores through the Fnac and Darty brand, which is more than well known. And so he knows very well, the area. The customers are used to go to its stores. So this is a win-win situation, both for Fnac Darty and for the franchisee. And for us, regarding Fnac Darty, the franchise model is that, you don't have to support all the costs. The operational costs are supported by, the franchisee. So for us, it's accretive on our EBIT margin. You don't have to support the CapEx side also, all the CapEx linked to the opening, the revamping of the stores, is for the franchisee. So for us, it's a good opportunity, and it's accretive on our EBIT margin, which is kind of important. That's the reason why we prefer now opening, through the franchise, because those are, smaller stores than the big ones we have opened since ages. So this is good, complementary to the fact we can expand, our store network with, I don't say no cost, but low cost for us.
Thank you very much, Stephanie. Thank you very much for your time, Stephanie. Thank you very much for your participation to the CSA Research Challenge and to Fnac Darty to be the subject of this year. Guys, the conference was registered. That's an innovation this year. So you will be able, or if there are people in your team that could not attend, to view the presentation from Stephanie again. Finals should be held on February 23rd of 2023. In the meantime, there are a wealth of information regarding the everyday plan or Fnac Darty results on the website in the investor site for your work. So don't hesitate to go there. And thank you for your presentation. Thanks again, Stephanie, and have a great afternoon.
Thank
Bye,
you,
guys.
everybody. Bye-bye.
Thank you very much.
Thank you.
Bye.